Hey guys, I'm Daniel. This is My Data Driven Life, and you are watching video number 4 in the Investing 101 series. So in this series, I'm trying to give a complete beginner as much exposure to necessary information for investing. And in this video number 4, I wanted to specifically cover some of the things that you have to think about from a human psychology perspective whenever you talk about investing. So I'm a computer scientist. I'm not a psychologist. So, take the term psychology loosely. I'm basically just talking about strategies to keep in mind, anti-patterns to avoid, stuff like that. So let's look at the summary. We're going to start out by talking about the term market sentiment, and I'll kind of explain that and talk just generally about what you should be aware of there. And then I want to talk about a big topic, which is the fear of missing out. And I think this influences a lot of retail investors' decisions. I wanted to talk briefly about day traders and why I generally don't recommend that you day trade. And then I wanted to talk about the strategy of timing the market versus some other strategies that might be a little bit more appropriate, especially for a beginner. And then I wanted to provide some practical examples of thought patterns that you should not have and what kinds of thought patterns you should have instead. And just a disclaimer, this is mostly based on my personal opinions and experiences, and this may vary somewhat from what people would consider the canonical truth about the psychology of investing, but I try to do my best to represent the topic as well as I can. Okay, so what is market sentiment? Market sentiment is the overall attitude about the health of a particular stock or security or a sector. And the general takeaway here is that market sentiment is not necessarily based on rational choices or rational information, or for that matter, the fundamentals of a stock. And stay tuned for the next video, because in the next video I talk about fundamentals. That video is all about fundamentals. So I'm just kind of listing some general things that contribute to market sentiment here. So market uncertainty certainly plays a role here. If you're in a pandemic like we are now, and that has obvious impacts on the economy, then you might not expect certain sectors to bounce back afterwards. And so that's generally already priced into certain stocks and sectors, but that is one of the facets of market sentiment. And then also there's the element of emotion when it comes to investing, and people tend to be afraid of the potential for a crash, and they may also have the potential to be a little bit too hyped about the performance of a stock, and that becomes kind of a self-fulfilling prophecy with the side effect of creating a speculative bubble. And on a more technical side, there are a lot of technical indicators that market analysts use to quantify certain aspects of market sentiment, and that includes things like the VIX, which is also called the fear index, high-low index. There's a ton of other technical indicators that people use, but I just wanted you to be aware of those. So fear of missing out, I think this is a big one, most commonly known as FOMO, and this doesn't only apply to finances and stocks, this applies to a bunch of stuff. So you've probably heard this term in other contexts before, but as far as investing goes, basically your decision to buy a stock should depend solely, or at least majorly, on the fundamentals of that company and the fundamentals of that stock. So by looking at earnings reports and financial statements, you understand how the business operates, what their assets look like compared to their liabilities, what kind of long-term debt they have. And I want to get into a lot more of that specifically in the next video. But then again, in making investing decisions purely based on fundamentals is easier said than done. There's, we're humans. I'm not talking about the bots that automatically buy and sell stocks here. I'm talking about retail investors, humans. We are humans, and we make decisions based on emotionally charged states of mind, and that certainly extends to stocks as well. And one clear example of this is the dot-com bubble that happened right around the turn of the millennium. And around this time, internet-based companies were really gaining attention, and people were speculating like crazy price-wise on these stocks for these companies. And what ended up happening was the stock price kept going up, and therefore the PE ratio kept going up because earnings were pretty gradual versus the stock price, which was growing, somewhat exponentially. And what do bubbles do? Bubbles pop, and that's kind of why it's called the dot-com bubble. So like I mentioned before in the basic terms episode, PE ratio is a good way to understand the valuation of a stock, and there's a good happy range, which is in like the 10s and 20s. That's a reasonable PE ratio. And a higher PE ratio might mean that the stock is a little bit overpriced. And that's exactly what happened overall for the market in the dot-com bubble. In the dot-com bubble, the NASDAQ reached a PE ratio of around 200, which is, roughly 10 to 20 times higher than it should be. And in general, the PE ratio works well on a macro level, like entire sectors, entire, major stock indices, and it also works on the individual level. So if you look at the individual stocks PE ratio and it's incredibly high, then, you might want to look more into it. So here's a recent example that's ongoing right now. I'm not saying that this is a bubble that's going to burst, but if you look at the PE ratio for Tesla, it is in the thousands, which is off by, a factor of 100 if you want to consider a good PE ratio a good indication of valuation. So I think there's a lot of future growth priced into the current price of Tesla, and we might see a correction to a more reasonable value at some point in the future. It may keep going up, who knows? And that's why it's a good idea to diversify and make sure that you're not going all in on one stock like Tesla. I just want to make it clear that I actually own quite a bit of Tesla stock. Not quite a bit. It's like 8% of my portfolio right now or something like that. So, it's a reasonable amount, but I do believe in Tesla as a company. I believe in Elon Musk as a CEO. Do your due diligence. I wouldn't say that Tesla stock is necessarily cheap right now. It's quite the opposite. As a general rule of thumb, as you saw in the previous graph, it's probably not a good idea to buy a stock if it's already growing exponentially, like especially in the short term. Like I think I'm mostly focusing on stocks here, but I think a better example is crypto, which is much more volatile, especially at the early stages that we're in right now. So, Bitcoin had this huge rally in 2017 where the price approached, I believe, like 19,000. Now it's, close to 40,000. So that's old news. But there was a lot of speculation and the price kept getting pumped up and up. And there's a lot of complicated reasons as to why there was such a huge correction. But, it kept rising exponentially to 19,000 and then suddenly dropped over the course of a few days or a few weeks to around 3,000. So rule of thumb, if you see kind of an exponential curve for the stock price, it's probably too late to buy in. You could probably buy a little bit, but definitely don't throw your life savings at it. Do your due diligence, understand why it's happening rather than just being hyped about the price and about potential growth in the future. So I wanted to talk a little bit about day trading because this is a topic that I was interested in when I first started learning about investing. I was like, hey, those day traders make a lot of money. Maybe I should try that. And the more I understood about it, the more I realized that day trading is basically glorified gambling. Unless you're really good, like you have a solid financial background and this is your day job. In that case, I think it's a little bit more reasonable. But even then, you have to really be on top of your game because you're competing not only against other, professional day traders, but you're also competing against bots. And so day traders basically trade on like an intraday basis, meaning like they buy a stock and then sell it again within the same day or maybe over the course of a couple of days. And there's a very specific definition of day trading as far as stock brokerages and taxes are concerned, but I won't get into that in this video. Should you day trade? Most likely not. I have an article that you might want to read if you look at the slide deck, which is linked in the description. But yeah, most likely not, especially if you're a beginner. One major argument for why I would say this is that trading as a whole is basically a zero-sum game. Liquidity in the stock market is purely additive. People that buy stock, you have other people that buy stock. If you sell your stock, then the total liquidity of that stock goes down. And that's basically a complicated way of saying that if someone is winning, then someone is losing. And in fact, around 80% of day traders do not turn a profit. On the contrary, the median loss tends to be like around 30%. And that's based on the link that I linked there. That's a study in, I believe, Taiwan. And then, that generally holds true globally as well. Timing the market. Don't. Okay, more seriously, there are a lot of variables at play here, and a lot of those variables are unknown to us, the investor, because they rely on trade secrets and things within a company that are not yet announced. And obviously, if you happen to know that information, that's considered insider trading, and that is illegal. So don't do that. If you work at a company that has stocks, then make sure that you follow their trading window guidelines and stuff like that, or you might get in a lot of trouble. But in general, timing the market is very, I would say, stochastic. It would not be an easy thing to predict. You can probably predict things on a longer timeline, but in general, what you should do is understand the fundamentals of the company you're buying stock from. And there's a strategy called dollar cost averaging. And this is the strategy I use, where on a regular basis, you take a predetermined amount of money and you put it into certain stocks, into certain sectors. And the effect is that you're basically getting the average returns of the market over a long period of time. And actually, you get to choose the granularity here. But if you choose like a weekly or a daily granularity, then you capture the best days of the market. So if there are days where prices crash significantly, like in March 2020, which was before I started investing, so I missed out on that. But if you were investing in March 2020 and the stock market crashed, if you were doing this in a way where you don't panic and you don't panic sell, then you had tremendous buying opportunities because the stock prices for a lot of stocks bounced right back after that. And so by dollar cost averaging, you take all the guesswork out of it, other than guessing whether or not the company will eventually go bankrupt, but that's where fundamentals come in. As far as timing the market though, there is sort of a strategy, and that's called value averaging. You're not actually relying on unknown information here. You're weighting your buys based on the severity of some sort of temporary dip in the price. And so basically what that means is, you look at a bunch of stocks, some of them are green, some of them are red. If you see that they're red, meaning the stock price has fallen a bit and there's no fundamental change in the business, then that means that you have a buying opportunity right there. Finally, I wanted to talk about some anti-patterns, and an anti-pattern is a common response to a recurring problem that is usually ineffective and risks being highly counterproductive. So basically, these are examples of things you should not do. And just to be helpful, I put examples of what you should do instead. So the first anti-pattern is stock is rising exponentially and could rise even more. So that's a good signal that I'm missing out and I should be invested in the stock, right? Well, you really want to just look at the fundamentals, which is the next video, stay tuned, and understand what's happening, understand why the stock is rising. And after you've done that, maybe you can make a more informed decision. Another anti-pattern, the stock price just crashed. I should sell before I lose more. My advice is to buy things for the long term, buy stock from a company, assuming that that company will be around and profitable until the day you die. That might be a little bit of a hyperbole. Generally, I tend to agree with that perspective. And so if there's something that fundamentally changed about the business, then yeah, you should probably sell. Like there are certain industries that probably won't ever recover after the pandemic and what's happened, because we're probably going to be doing business in a different way now. So like if you have stocks in, let's say, shopping malls may come back, but it may not be as widespread as it once was. So, that business real estate might end up being used for other stuff, like, for example, fulfillment centers for like, Amazon and other companies that want to ship stuff. Another anti-pattern. This stock has a huge upside. I should invest as much as possible in this stock to maximize my gains. So, my mind keeps going back to Tesla, because Tesla is a stock that I'm really excited about. They're not only doing electric cars, they're researching full self-driving capability as far as software and hardware goes, and that's going to be extremely valuable. And they're going to turn that into a rideshare business at some point in the future once they reach level 5 autonomy. And then they're also invested in solar panels and the energy sector in general, researching battery technology, not only for cars, but also for houses and for grid storage. So they're doing a lot of stuff, and I'm sure they're going to come up with more stuff to work on in those areas as well. In general, they're not just a car company, they're an energy company. And for that reason, you could argue that the stock price right now is still low compared to where it's going to be. It could go from what it is right now, which is, I think, like $800. It could go all the way up to, $1,500 or $3,000 even. That might happen someday, but you don't want to put all your eggs in one basket, because, then bad things happen. What if, and I hope this isn't the case, what if Elon Musk dies, or there's this huge scandal within the company and it just falls apart? Then all that money that you've invested in the amazing future that Tesla is hopefully going to offer, it just goes down the drain. So you want to avoid going all out on something. And if you look at the Wall Street Bets subreddit, you see this all the time. They'll go all out on a stock. And some people will have big wins and some people will have big losses, but that's because they're essentially gambling. Another anti-pattern. A YouTuber said I should invest in stock XYZ, and then you proceed to invest in stock XYZ. Just because I keep talking about Tesla does not mean that you should go and buy Tesla right after this video. I 100% do not think you should do that. And I 100% don't think that if I make any video about a particular stock in the future that you should do that either. What you should do is consider my opinion on the topic and consider other people's opinion on the topic, and then make an educated decision. So that was kind of a shorter video. Hopefully we'll see how this turns out after it's been edited by my amazing editor Buzz. This was the psychology of investing video. The next video will be about fundamentals, where we'll talk about stuff like financial statements. So stay tuned for that. And after that video, we're going to get into the real meat of things, where I offer a beginner strategy, and I'm going to specifically say, you know, like diversify across these sectors, and these are the ETFs I suggest, you know, stuff like that. So a lot of fun stuff to look forward to. And finally, like I say in all my videos, join my Discord if you are a Discord kind of person, and we are going to have lots of fun there. And by fun, I mean I'm going to spam you with information about the videos that I'm working on and ask for feedback, and keep linking to videos that I find interesting. And yeah, so if that sounds like something that you're interested in, then join my Discord and smash that like button, smash that subscribe button. And if you're still watching at this point, yeah.